Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories now we are following in the BNN Bloomberg newsroom. And Canada and India have pledged to expand trade in the oil and gas area. This pledge comes after a lengthy diplomatic chill between the countries. Canada will ship increased crude oil and liquefied natural gas, while in return, India will send more refined petroleum products. The Canadian energy minister says these talks show the country is committed to diversifying its trade partners. Cogeco Communications, one of the biggest laggards on the TSX today. It's off by 6.8%, almost 7% after Lacasse said it intends to sell part of its stake in the company. That 11% would generate about $229 million and is linked to the investor's portfolio rebalancing. Lacasse says it continues to have confidence in Cogeco and its direction. The funds from the sale will also be used to support and grow companies in Quebec. Another one taking a hit. Metro off by about 6% right now. The grocery chain posting its lower profit in the first quarter, weighed down by the temporary closure of its frozen food distribution center in Toronto and food inflation pressures. In addition, sales from Christmas Eve will now be accounted for in the second quarter. On the upside, revenue rose more than 3%, with growth in same-store food and pharmacy sales as well as online sales. And heading to the markets right now, you can see the TSX struggling today, but still over 33,000. It's just dipped below there. It's down by about 0.29% right now. South of the border, real mixed bag. You can see the S&P 500 is up 0.33%, but look at the Dow now. It's off by more than a point. Healthcare, one of those driving it down right now. And the NASDAQ, it is up by 0.83%. So what is trending today? Let's have a look at some of those leading the way and some of those doing not so well. First up, Nova Gold. It is doing quite well right now. It's up by 8.5%, almost 8.6%. So no complaints there for Nova Gold. And another one we're looking at on the positive side is Celestica. And it is doing quite well right now. You can see it's up by 6.14%. And on that one, it's reporting its results. Shares are up right now on those results. And so you can see it was up as much as 12% at one point. It's calmed down a little bit, up by about 6.3%. Cogeco, as we were talking about, it is down 6.8% right now. Lacasse selling 11% of its 11% stake in it, and that has people a little nervous as well. Also, Metro, of course, was the other one we were just talking about in the headlines. You can see it's off by a little under 6% right now, and results for Q1 disappointing for many. Also, Aya Gold and Silver is another one I want to take a look at, and it is off by 6.25%, we'll say right now. It outlined 2026 production, and it is not satisfying people. Some other notable movers. This one is what's dragging down in the States there. United Health, disappointing. The forecast, disappointing. Decline in 2026 revenue. And so you can see it's off by nearly 20% right now. And United Health, part of the earnings season, slowly kicking things off. We're also awaiting, of course, tomorrow's U.S. Fed, the Bank of Canada rate decision announcement as well. Lots going on. And get their take on it, his take on it, Art Hogan, Chief Market Strategist at B. Riley Wealth. Art, thanks very much for joining us today.
Thanks so much for having me.
Okay, earnings season overall, what we're seeing, are we liking what we're seeing? Is it what's expected?
Certainly liking what we're seeing. Interestingly, the first week always kicks off with the financials for us in earnings season, and they all were across the board better than expected. But most of the names came in at or near all-time highs, which makes that reaction function a bit difficult. So you spin forward to the second week, and you had a broader spectrum of S&P 500 companies that reported, but less than 1%. This week is the week where we're really in the Super Bowl of earnings. We've got 135 S&P 500 companies reporting from a vast variety of sectors, and I guess people will be watching the most closely some of the Mag 7s, of which we have 4 over the course of the next 2 days reporting. And I think that the interesting thing about the Mag 7s is none of them are coming in at or near all-time highs. There's been quite a reset where a lot of these names haven't done much in a couple of quarters. So I think you have the opportunity to see some upside movement. We're starting to sniff that out today in some of the tech stocks, and certainly the NASDAQ outperforming the S&P.
There was almost some disappointment in the last quarter for the Mag 7, even though they had great numbers for the most part. There was almost disappointing because people were expecting a little greater. Will this kind of calm things down and people will take a more sober look at it?
Yeah, Roger, I think there's 2 things going on. I think there's those companies that are actually investing in artificial intelligence, the hyperscalers that are developing large language models to get to the ultimate dream of agentic artificial intelligence, that are doing that with mostly free cash flow. And those companies put up great numbers and get rewarded for it. But those companies that are actually trying to build out that artificial intelligence dream but are taking on a lot of debt just aren't rewarded the same way. The ultimate question for everyone is, when do we get that return on invested capital? How soon should we expect that? And are we starting to see some of that now? But it's the differentiation really has been, can you do most of this spend out of free cash flow, or are you really taking on more and more debt every quarter to actually continue this CapEx spend? And I think that's where you see the difference between a company like Alphabet or Google and Meta or Facebook in terms of how they're financing a lot of this CapEx spend.
And are people starting to look for a new Mag 7?
Yeah, well, I think we're up to Mag 10 by now. I think that you've got some of the new entrants, the artificial intelligence darlings, like Broadcom was certainly ushered into the artificial intelligence world. I think that as we broaden this out a bit, I think AMD has slid into this top 10 in terms of names. But I also think that as we look at this artificial intelligence revolution, you've also seen things like industrials do better because of the data center build out. You're seeing utilities do better because of the massive amount of power needs. So when you think about artificial intelligence, it's not just NVIDIA and a bunch of hyperscalers anymore. That was 2 years ago. I think this year everyone's looking for that artificial intelligence adjacent play, and there seems to be plenty of those as the market broadens out.
And I imagine people are starting to want to look for the companies that are actually using AI and really benefiting from it.
Yeah, I think that'll be the interesting part of this S&P 500 reporting season, is that companies will actually tell you what they're doing, not just how much they're spending, but actually what they're using artificial intelligence for, and how much it's increasing their productivity, and how much of that is accretive to their earnings. And I think that's the critical juncture we're at now. So it was really exciting 2.5, 3 years ago when ChatGPT rolled out, and now it's getting even more exciting as corporate America embraces this and talks about just what this is going to mean to their business model, and how much that's going to increase their profitability.
And is there one sector more than the other that's kind of leading the way on that?
Well, I'll tell you, in the early timeframes, I think that the sector that's going to benefit the most likely are the financials. So the adoption of artificial intelligence in all things financials, whether it's the money center banks, the investment banks, the regional banks, I think there's the first mover advantage for the financials that are increasing their productivity straightforward. And you're already seeing that in some of the hiring patterns, the just out of college analyst, those numbers are coming down, productivity is going through the roof, and the ability to put out things to get M&A transactions done and to get companies listed publicly, the time to get to market is shortened up a lot. So I think financials are one of the early beneficiaries there, but I don't think it's limited to that. I think there's 11 sectors in the S&P 500. Each and every one of them will have some adoption of artificial intelligence through the course of the next year or two that's going to increase their profitability and certainly increase their productivity.
All right, let's jump over quickly to the Fed and the Bank of Canada rate decisions tomorrow. It looks like going to be stand pat.
Yeah, very much so. And one of the things about the Fed is they're just now starting to catch up on real-time economic data. So to make a decision in that world where there's still a lot of noise from the government shutdown and the data they received, after having cut 75 basis points over the course of the last 3 meetings, I think it's a perfect time for them to take a step back and say, how close are we to neutral, and which one of our priorities. Which one of our mandates do we need to defend more? Is it the inflation piece of it, which still seems to be above target but calm? Or is it the labor market and the full employment mandate, which still seems to be a rocky picture with outdated economic data that they're using? So to the extent that once we get a string of economic data that's real time with the government now being open, hopefully staying open, I think we'll have a Fed that can actually have a better decision-making process. And therefore, I don't expect them to do anything at this meeting or the next two.
Okay, we'll wrap it up there. Art, but thanks as always for joining us. Appreciate it.
Thank you.
Art Hogan is Chief Market Strategist at B. Riley Wealth. Coming up, shares of General Motors are accelerating after the automaker forecast profit growth of as much as $2 billion US. We'll hear from the company's CEO after the break. Shares of General Motors are trading higher today, even near record territory. The automaker is forecasting profit growth of as much as $2 billion US and has increased dividends and buybacks. Our partners at Bloomberg TV spoke with GM CEO Mary Barra.
2025 was an exceptional year, especially when you look at all the challenges that we face. And I think it really demonstrates one of the core capabilities of GM, and it's our agility and our resilience. But the core of it starts with our great product portfolio, whether it's very affordable EVs like the Chevrolet Trax, all the way up to, you know, a supercar like what's behind me with the Corvette ZR1X. So couldn't be more proud of the team.
The ZR1X with 1,250 horsepower. It is indeed, I would call it a hypercar, Mary. That's not the bread and butter, though, for you. You really make these highly profitable, highly capable big trucks, and Americans are buying more of those and fewer of the EVs. Do you expect to continue to sell fewer of the EVs? I know you took a $7 billion and change write-down for that business in 2025.
Well, you know, the whole industry, we were on a path that we were working to get to 40 to 50% EVs by 2030. So now that the regulatory environment has changed and the consumer incentives have gone, there is going to be slower EV adoption. We're still committed to EVs, and we've got a great portfolio that we're working on taking costs out of. But in the meantime, we also have a great internal combustion engine platform. And you're right, full-size trucks are one of the strengths we have, as well as full-size SUVs, mid-size crossovers. So we really have a strong lineup across the board, and that is really what is, fueling our business success.
I have had, as the host of Hot Pursuit, a Bloomberg podcast about cars, the opportunity to drive a lot of your EVs, from the Sierra EV to the Hummer EV to the Escalade IQ, and they're fantastic products. Are you not deterred that Americans aren't buying more of these vehicles? You know how capable they are. You know how useful they are in daily life. What needs to happen for more Americans to buy these EVs?
Well, I think the consumer is very rational when they're making a decision about what car to buy. Let's remember, it's one of the most important and expensive decisions that they make. And one of the things we have to continue to work on to drive EV adoption is a more robust charging infrastructure. And that still is continuing to happen. So every quarter, more and more chargers are available. I think as people in their individual communities see that they've got a robust charging network and believe if they have to go on a road trip, there's that as well, they're going to make that choice. And what we do see is once someone buys an EV, they see the technology, they see the driving experience, never having to go to the gas station, and they stick with EVs. So I think it will happen over time, and that's why during this period we've already got a great portfolio of EVs. We're going to continue to take cost out to get our EV portfolio profitable, and we're going to be well positioned as EV demand grows over the next handful of years.
What about the hybrids, Mary? I mean, GM was really a front runner, not only in EV technology, but in hybrid technology with the Chevy Volt. I remember when the Tahoe came out with a 6-liter gas engine and electric battery power. Will you start to sell more of the hybrid vehicles?
Well, we have always focused, as you said, we have great hybrid technology. We have great EV technology. We're one of the few OEMs that invested in a dedicated EV platform that allows us to have the portfolio we have. So we're focused on the end game, and we have affordable EVs. So I think that's where our primary focus is. We understand the technology. We have it in other regions. You'll see us with a handful of hybrids as we move forward. But right now, our focus is really on having the right internal combustion engine portfolio and the right EV portfolio moving forward. And I think we're demonstrating that that's a winning formula, because over the last 4 years, we've gained share each year.
I wonder how much your racing efforts push towards that. And I know this is something I've talked about with your president, Mark Royce, on a number of occasions, but you're getting into so many more leagues. I watched the hypercars in Le Mans this summer, and looking forward to watching you participate in Formula One. Do you think this really boosts your brand awareness around the world?
Absolutely. We definitely see that it does. And I think, when you look at Cadillac and the strength of Cadillac, it is true luxury, true American luxury. F1 is the place that Cadillac should be showcased. So we're very proud to be a full works American team, anxious to enter this year in Australia. But I think it's going to be very important for the Cadillac brand. And we do have a really robust program that takes what we learn on the track and we incorporate it into our vehicles to make our vehicles better. It's true for Chevrolet as well as Cadillac and the entire portfolio.
I got to ask about the finance arm. GM Financial provided a massive liquidity buffer, I think $36 billion there. How do you think about, because you're doing buybacks, returning a lot of cash to shareholders, I'm sure they're happy about, the stock is near an all-time high, but how do you think about putting that aside for protection versus supporting shareholder returns, in case the auto cycle turns at some point?
Well, we've indicated that 18 to 20 billion is our cash target. Last year, we finished the year strong at around 22 billion. And we have a capital allocation framework of first reinvesting in the business, second, making sure that we have an investment-grade balance sheet, and then returning cash to shareholders. And we think based on the strength of our business and the cash that we generate, we can continue to do that well, and that's where our focus is.
The financial arm has added, I think, more than $2 billion to 2025 profits. So it's really a contributor, kind of a quiet profit stabilizer. Is that turning, though, as delinquencies and charge-offs rise a little bit? Is that starting to concern you as consumer balance sheets thin out?
Well, it's something that we watch very closely, but I think GMF does a great job in their business, and it is a very important business. Shout out to the GM Financial team for the great work they do. It's also very important from a loyalty perspective, because having a captive and being able to interface with the consumer on a monthly basis as they make their car payments, I think is just part of the ecosystem that we're building to really make sure we have that great relationship with the customer, and it shows that we have the highest loyalty in the U.S. of any OEM.
I look at loan originations in the fourth quarter, and I see that they're down pretty substantially, about 21%. And I wonder if that's a deliberate choice by GMF. Are you tightening your credit standards, or is that reflecting a softer demand at today's rates and prices, which are both fairly high?
Well, the car company and the finance company, they work together to make sure we have the right equation and what's going to optimize, profitability for the enterprise. And so I don't think you can look at one quarter. It goes up and down depending on what's happening in the external world. But GMF is a very important part of our portfolio of companies. And again, as I said, it works in concert with the car company to make sure that we have a strong business overall.
I have to, when I think of credit standards, I think of First Brands among some of the other businesses that have fallen to Chapter 11 this year. And I saw a report in the Financial Times overnight that you, along with Ford, your crosstown rivals, are negotiating to help send them a rescue line of sorts. Can you comment on that at all, Mary?
Well, what we're very much focused on is while we make sure we have secure supply is that transition period. So I think what you see General Motors and other OEMs working together to do is make sure that we don't have supply chain disruptions because of their financial situation. We've been working on it, but I think as we look at the immediate, what's happening next week, next month, that's the work that we're doing, as well as in parallel making sure we have longer term supply. So that's what you're seeing with that announcement.
When you talk about the supply chain, I think about the concessions you're able to get out of your suppliers. I know that you're trying to keep costs down. You're under a threat of tariffs, or you already face tariffs in a lot of the places you produce. How much of those tariffs have you been able to pass through to consumers where you haven't been able to cut costs or get concessions from suppliers?
I think if you look at our portfolio, I think, for the most part, we've worked to offset it and with efficiencies across the board, making smart decisions on where we produce. And so very little has gone to the consumer because we are such a cost-sensitive business, and it's such a competitive business. But we continue to look at all of those levers, and we stay focused on consumer affordability.
And that was GM CEO Mary Barra speaking with Bloomberg Television. Well, U.S. ski resorts are seeing a decline in Canadian visitors from the precipitous in places. We'll talk to Bloomberg's Anne Riley about what is going on. The snow we've seen across North America this last little while, one might think skiing is a great idea, but if you're Canadian, you may not be hitting a slope in the U.S. Ski hills there are taking a hit. For more on this growing trend, we're joined by Bloomberg's Anne Riley. Anne, thanks very much for joining us. The U.S. ski resorts are seeing a decline. Just how much?
Yeah, well, it's a little early to know for this season in that the big week for Canadian skiers is actually in March. But based on what we are seeing so far, it seems like Canadian visitors are not showing up on the U.S. slopes like they'd been expected due to President Donald Trump talking about Canada becoming the 51st state. I mean, there are a whole load of things you could point to. At the start of the season, I mean, even back last summer, it looked like Canadian visitors were going to be down about 35% at some of the slopes. Now, maybe it's down more like 15 to 20%, kind of depending where you're looking. But it is still down, and that's even with a wonderful season of snow. So that has a lot of resort owners a bit concerned.
You mentioned the Trump factor there. Do we know how much of a factor that is, or is it the dollar being weak against the American dollar?
I mean, it's a great question, and surely there are lots of things going on. But a lot of these resorts, especially the ones in Vermont, in border towns and border states, they've been accepting the Canadian dollar on par with the American dollar. So trying to counteract, any currency issue that may be at play here. We certainly know anecdotally, talking to skiers on the slopes, that they don't like the rhetoric in the U.S. and there seem to be plenty of great skiing locations in Canada. So it almost feels like a political statement, not to cross the border. So that seems to be what is going on here. And
that on par deal, is that helping? Is it working at all? Offset it?
I think it is helping. I mean, we've heard about the owner or the manager at Jay Peak, for instance, calling up every season pass holder personally from Canada to ask them to renew, taking the looting on par with the dollar. A lot of these resorts are translating more marketing into French and trying to appeal to Canadian neighbors. So they're pulling out all the stops, and some of it is working. Clearly, visits are not down as much as everyone had feared. That said, there is some data that we run in this story from a group called Intopia, where they see that every time President Trump says something about Canada, something negative about Canada, within 48 hours, we do see bookings to these U.S. ski resorts drop. So it feels like there is some connection here.
And now you mentioned the big tell might be March break. Do we know what kind of an impact it's having now or what they might be expecting by the end of the year?
Yeah, it's hit or miss. Every time a new snowstorm comes and we get new powder on the slopes, it helps. Sometimes people can put things behind themselves for great skiing. Though anecdotally, some of the people that we talked to for this story did renew for the 2025-2026 season. They're out there skiing right now in Vermont, and they have already said they're not coming back next year. I mean, it seems it's kind of one step after another. It's the 25% blanket tariffs on Canada, and then the talk of 51st state, and now in the last couple of weeks, Trump talking about, well, maybe 100% tariffs on Canada if they make a deal with China, or maybe Canada can't be on Trump's board of peace. It just feels like one thing after another, and some of these skiers maybe are going to opt to stay home going forward.
And I have to ask, you look like you're at a lodge right now. Are you skiing?
I am not skiing. I'm actually at home, but we got a lot of snow yesterday in upstate New York, so I spent all day sledding with my two sons. So almost the same thing.
All right. Well, enjoy the fire behind you. Thanks very much for joining us, Ann.
Thanks for having me.
Bloomberg's Ann Riley. Well, American startup incubator Y Combinator has removed Canada from its list of countries where it will invest. We'll discuss what this means for Canadian startups after the break. Shares of Algoma Steel are getting a boost after the company signed an agreement with South Korean shipbuilder Hanwha Ocean for Canadian Navy subs. The agreement is potentially worth more than $300 million and is contingent on Hanwha winning a military contract for a new fleet of subs. If a contract is secured, Algoma will develop a steel beam mill. The news comes as Algoma continues to deal with hefty U.S. tariffs on steel and aluminum. Shares of UPS moving up about 3.28%, just jumped up to 3.35%. This after the shipping giant forecast full-year sales that came in above Wall Street estimates. The company now projects nearly $90 billion in revenue for 2026, marking the first time in a year the courier has provided a full-year sales outlook. The forecast comes as UPS carries out a new profit-boosting plan, which saw it cut deliveries for its largest customer, Amazon. Now, going the other way, United Health, look at that, off by nearly 20% right now. The healthcare giant is forecasting a decline in revenue for 2026, marking the first annual contraction in more than 3 decades. The U.S. is planning to hold payments flat for private Medicare, is adding pressure to the insurer. United Health is also shedding insurance membership, divesting overseas assets, and shrinking its U.S. footprint for some areas. And a quick peek at the markets right now. You can see TSX still in the red right now, off by about 0.22%. South of the border, a bit of a mixed bag. You've got the S&P 500 up 0.5 point. Dow Jones, though, off by nearly a full point, and the NASDAQ is up, by a little more than a point. Y Combinator is a U.S.-based startup incubator behind companies like Airbnb and DoorDash. Recently, the company removed Canada from its list of countries where it will invest. Canadian startups will likely have to register as a U.S. entity to get any funding or any hope of funding. Here to talk about this and get a little more detail on it is Abdullah Snowbar, the executive director of DMZ. Abdullah, thanks as always for joining us. Good to see you.
Good to see you as well, Roger.
Are you surprised by this, or is this something that was coming?
I don't think I saw it coming, to be quite frank, but I'm not surprised at the same time as well. And I think when I look at it, my knee-jerk reaction wasn't to kind of come to any conclusions, but rather try to understand the logic of why this would happen. And I think in the simplest way to put it, a lot of it comes back to maybe just structural ease of Y Combinator being able to do business and work. And Roger, they positioned it in that they'll work in 3 countries. It was the U.S., it was Cayman Islands, and it was Singapore. Mm-hmm. And a lot of those, there's a lot that those 3 have in common, including some maybe ease of or relaxation around taxes and the tax structures that exist there. So I think a lot of it has to do with that specifically. So I wasn't necessarily surprised.
Are we far off what they would like to see for tax structures and things like that, or does Canada have a long way to go to try to even hope to compete for this?
Yeah, look, it's going to be a long way to go, and I think it's no surprise if someone says Cayman Islands, or if you even think about a Delaware Corp. These are structures on the tax side that are very, very favorable to businesses, and usually, much more, much lower kind of tax rates than what you would ever see in Canada. But and again, just to note, it's important to realize that the CEO of Y Combinator is actually a Canadian from Winnipeg, I believe.
Yes.
And his name is Gary Tan, and he made it very clear that this is nothing against Canada, just rather this is a business move around ease and clarity and the ability for Y Combinator to move faster. And I think it's also important to realize that a lot of our companies that do end up going to Y Combinator anyways typically end up establishing or building a U.S. entity to kind of leverage into a bigger market and more favorable tax terms. So this generally did happen already in many regards. The reality is now is that they're just going to be very particular on whether or not from the get-go they will accept a Canadian company to join a program and get investment before they maybe restructure their businesses to be a U.S., Cayman Island, or Singaporean business as well. So there's that. A really important note to also make, Roger, is that I don't want to over-index the amount of companies that Y Combinator has helped in Canada. Although even from our program, we've seen a lot of our great companies go through the Y Combinator program, a lot of great companies have not. And I think it's just an important point to note, not taking away from the program, Y Combinator is a world-class program and investor. They've done incredible work across the board, but we've seen companies that haven't gone through these programs that have done just as well.
And do we have a good incubator system here in Canada? And do we have companies that are startups that are willing to stay or wanting to stay in Canada?
Yeah, look, and everybody would come in with different reasons as to why they're going to stay, why they need to expand. But look, more broadly, Canadian companies are global companies, they're global businesses, and they want to be able to grow and expand as much as they can and capture a bigger market size where they need to. And Canada has established quite a big network of incubators and accelerator programs. Where we need to do better is at helping Canadian companies scale. And that's probably one of our our shortcomings, I should say, that can be an area of opportunity. Maybe this is a good wake-up call for us to talk to different, private sector and government partners and VCs to say, what can we do to establish a stronger scaling kind of ecosystem for Canadian founders and startups to continue building their companies out of Canada. We do have a strong system, and in many cases, what Y Combinator has is an incredible network of investors and private sector and corporate partners, and they can move at a pace that, quite frankly, a lot of other organizations cannot move at. But in the case of an organization like the DMZ, we've been around for almost 16 years right now, and we've seen a tremendous number of companies who have scaled to become magnificent businesses globally, and we can do way more of that. We just need to be able to focus on maybe backing winners and winning organizations to continue doing more of this work.
All right, I just want to ask you, want to get a free plug for some of the companies that have come through DMZ and how they're doing?
Well, look, one of the biggest companies that has come through the DMZ has now made it out and is valued at billions of dollars is Ada Support, an online chatbot. But you also have companies non-traditional, but have also gone through Canadian and U.S. different kind of programs. Majuri, a widely loved jewelry brand across Canada, U.S., Europe, UK, and even Australia. And they continue to expand. And these are companies that have been built right here at home in Toronto and continue to do great work that they're doing. So we have great companies that are coming out of the programs in Canada that are able to continue calling Canada their home.
Now, I mean, this is a lot of risk, and it takes a certain type of personality. Canada, we are perceived sometimes as being a little risk averse. We like safe. Is there a stomach for it here?
That's a great question, and I think maybe if you asked me this maybe last year, I'd say no. We're still at a point where we're still very risk averse, and we don't have the stomach for it. But I think times have changed geopolitically. I think we're realizing that Canada needs to step up and start doing more, and that comes both on national security, but also on economic prosperity. And I think we have to kind of tie the two in together, quite frankly. And we need to start shifting our mindsets. We need to start shifting the way that we think and operate and do business. And this is how we win. This is honestly how we can step up and become a world-class country that is competing on a global level by supporting great companies to continue their journey in what they call home, and continue bringing in the the benefits of the economic kind of opportunities that come with building a business.
And I mean, obviously, government has a role. What would you like to see from them?
Well, look, a lot of it comes back to continuing playing in the favor of entrepreneurs and founders, supporting tech companies, looking at procurement processes, ensuring that this whole idea of Buy Canadian is really going to allow even small and medium enterprises and startups to kind of leverage that narrative. So it's not just a program for big companies in itself. And ultimately, we need people like our prime minister and different ministers to continue putting these startups and big and really high potential companies on the map whenever they travel the world.
Okay.
Bring them with you. Showcase them. Put them on a pedestal. Let the world see what Canadian talent and technology is made of, because it's world class. We just need to do a better job of telling the story, shifting our narrative, and making sure that the world understands what Canada offers.
All right. I know you could talk more about this, but we have to wrap it up there. Always a pleasure to talk to you, Abdullah.
Thank you so much, Roger.
All right. Abdullah Snowbar is Executive Director of DMZ. Coming up, hot picks and big tech. All of these stocks are trading at 20 or more times earnings. Our next guest says they're still trading at rational valuations. Stay with us. Now for some hot picks, we zeroed in on 3 plays in big tech with Ernest Wong, head of research at Baskin Wealth Management. And we kick things off with his first idea, Microsoft.
If you look at the who is going to be a winner in enterprise AI, it is companies that have the consumers and the enterprise customer base and solutions that customers can trust, can protect their privacy. And that's what Microsoft has. They've already had good success in cross-selling Copilot to their 365 customer base. And we think that they will continue to roll out more AI solutions to their customers.
What about their role in AI? I mean, are investors worried that they're not going to reap all the benefits of artificial intelligence?
Yeah, so I think the stock has underperformed in the last few months because of worries that about vibe coding, about worries that they've been losing contracts to Oracle, and that they kind of hitched their wagon incorrectly to OpenAI, just as Gemini and other competing models are outperforming. We view this a little bit differently. We think the share loss to Oracle is something that they did deliberately and reflects strong, prudent capital discipline on the part of Microsoft. And we think that the cloud business is performing very well and will continue to do so in going through to 2026.
We're tight for time. Another name is Amazon.com. You say there are worries here that AWS, their giant cloud computing business, might be losing market share. Why is that?
So AWS has certainly been growing less than their competitors, Google and Microsoft, over 2025. We think this is more of a function of supply issues rather than actual demand, and should be resolved going forward. And one other thing to point out for AWS is that Amazon has a partnership and owns 15% of Anthropic, which is the hot name in the AI coding space today. Beyond AI and AWS, we think that the retail business is also performing very well. It's at record margins. The advertising business is growing double digits, and they're looking for ways to use AI to drive their retail business and improve costs as well.
And then finally, Taiwan Semi. What could go wrong? I mean, it's easy to construct a bull case for this dominant chip player. I mean, short of a Chinese invasion of Taiwan, heaven forbid. I mean, I shouldn't say that in a flippant way. What could go wrong for Taiwan Semi?
No, that's exactly right. Taiwan Semiconductor is the only manufacturer of all the leading edge chips that are powering everything in AI. What we like about the company is that they've historically been very disciplined at managing capacity to ensure that they're not holding the bag when demand falls. And even in we think that the worries about the stock and why it's trading at such a modest valuation given the growth is obviously because of worries about China. We think that China itself, they rely on Taiwan semiconductor chips as well. And in that event, if there was an event, I think that all of the big techs, other than Taiwan Semiconductor, Apple, NVIDIA, Amazon, they're all going to have big issues as well. So very motivated to ensure that they are building the fabs in the U.S. and around the world.
And just comment, Taiwan Semi are dominant. It's interesting, the world economy is so reliant on just one company. But are there any plans to Intel and other companies to build facilities that will compete with Taiwan Semi?
No, and I think that's one of the things that we like about Taiwan Semiconductor is because all the companies are so reliant on this one company, they are very motivated, and not just companies, governments are very motivated to ensure that fab and chip manufacturing capacity is available in the rest of the world. That's why we saw the U.S. sign a deal with Taiwan, where Taiwan Semiconductor would be building more fabs in Arizona. They're building fabs in Japan. They're building fabs in Europe as well. And we view this as a growth opportunity for them going forward.
I don't know, can you give me some insight? How did Taiwan become so dominant in chip making?
Yeah, so it's actually a very long story. Basically, they have the best technology. I think what's unique about Taiwan Semiconductor compared to companies like Intel and Samsung is that they are purely able to focus on manufacturing chips. And so as a result, they're not competing with their customers. They're able to focus all their efforts and the capital on ensuring that they're making chips to the best of their ability. Being able to manufacture leading-edge chips and having enough capacity to meet the growth in whatever is coming along, whether it be AI or self-driving cars. And I think that customers appreciate that.
And he was speaking with Ernest Wong, head of research at Baskin Wealth Management. Still ahead, today's market movers with Bloomberg's Matthew Griffin. Time for some movers south of the border. We're joined now by Bloomberg Equities reporter Matthew Griffin. And Matthew, thanks as always for joining us. First up, UPS, lots going on there. Earnings, but then beyond as well, layoffs.
Yes, Roger, there is a lot to sift through with UPS's report and their guidance. The company plans to cut 30,000 more jobs this year as it continues a cost-cutting effort. But what investors and analysts are really focused on today is a fourth quarter profit beat and a pretty good revenue outlook. The company expects $90 billion in revenue this year. Analysts wanted about $88 billion. UPS, this stock is still beaten up. They are cutting business with Amazon. They're facing tariffs, but there are a few bright spots in the report, and that's lifting the stock today.
Yeah, with Amazon, how much are they cutting, and what's their rationale for that? I always thought you want to be busy.
Yes, the Amazon business, I don't have the exact number in front of me of what they want to cut, but it's pretty significant. Those packages, it's a large business line, but they are lower margin packages. They're less profitable. And what Truist says is the big takeaway from this report and guidance is that UPS is aiming to be and transitioning into a higher margin company in the future.
All right. And next up, United Health, ugly.
Yes. Investors in United Health have taken a real 1-2 punch since yesterday's close. Health insurers as a whole are falling on news that the government plans to hold Medicare Advantage payments just about flat next year. That cuts out a huge profit growth engine for the sector. And then United Health this morning forecast the first annual revenue decline since 1989. That comes as they pull back on parts of their business. For example, their Optum Health, that's their care delivery unit, and profitability there has been hurt by government policies limiting payouts as well. Now, investors really hoped that Donald Trump would ride to the rescue of this sector, but so far, at least, he is focused on affordability, and that is a problem for the administration's policies towards these companies, at least as far as investors are concerned.
Okay, we've got about a minute. I want to get in the last one. Cloudflare with it's Moltbot. Who comes up with these names? Or not it's Moltbot, but its involvement in Moltbot.
Yes, so Cloudflare is higher for a fourth consecutive day. Analysts are bullish on its use with an open source AI tool. It's called ClaudeBot, different spelling, but actually works with Claude, Anthropic's AI model. It basically is an AI assistant, sort of a proactive AI tool that messages you first, is how I understand it. Cloudflare helps secure your connection to this tool, and software stocks as a whole have taken a beating on fears of AI competition, but investors actually see these tools as bullish for these security companies like Cloudflare because you might need these security tools while you're using the new AI programs.
Okay, I just noted, you said ClaudeBot. Apparently, it was they had to drop it because of trademark issues. All right, we got to wrap it up there, sir. Have a great
did
day.
They?
Yeah,
Wow.
we got to wrap it up. Bloomberg's Matthew Griffin, and that wraps it up for this edition of Trading Day. Have yourself a good one.